This is the Equity Management Academy Mean Reversion Trading weekly podcast for January the 4th, 2022. Gold. A reversion to the mean is long overdue. Summary. Gold is down in part because the 10-year note has shot up about 10 basis points to 163.5. So interest rates are rising. We may possibly be in the last phase of the pandemic, but still a great deal of uncertainty. Inflation continues to affect every sector of the economy. There are also supply shortages across the board. Gold and silver are the only commodities in the negative territory, which is highly unusual. Fundamentals. Gold is down to 1802. Gold is down in part because the 10-year note has shot up about 10 basis points to 163.5. So interest rates are rising. Silver is at 22.79, also down. We are buying silver at the market at 22.82 on the May contract. The target is 23.15. Bitcoin is about $1,100 or a little more than 3% up. Bitcoin is in a bearish weekly price momentum, but a daily bullish signal unless we get above 48,087. The Equity Management Academy CEO Patrick MontesDeOca said, one of the fears in the market is about interest rates. The economy is showing some resilience in terms of retail sales, but the Omicron variant, which is highly infectious, may harm the market. We may possibly be in the last phase of the pandemic, but still a great deal of uncertainty. We could have more lockdowns. It sounds like March 2020. But it could potentially be the end of the pandemic. Inflation continues to affect every sector of the economy. There are also supply shortages across the board. Gold is down about 4 or 5%, and silver is down about 13-14% for the year, which are tremendous anomalies since we are moving into a highly inflationary period. Gold and silver are the only commodities in the negative, which is highly unusual. Gold and silver will act when you least expect it, MontesDeOca said. Price discovery will adjust gold and silver prices upward rapidly at some point in the near term. A key issue is whether the velocity of money will increase, leading to further shortages in the markets. The Fed and government are printing more money, thereby debasing the currency. The Fed policy is to decrease the buying of bonds by $30 billion each month, which will take us into the third quarter to bring us down from this massive stimulus program. The next move would be whether interest rates will be raised. We are moving into a potentially slow economy, MontesDeOca said. It is unlikely the Fed will raise interest rates significantly in the face of a $30 trillion in debt. However, the market may drive interest rates up, especially if the Fed continues to pump stimulus into the economy. It is my conviction that interest rates cannot go up in this environment. We are seeing a tremendous increase in value in real estate and other hard assets, which reflects the weakness of the U.S. dollar. Inflation will increase pressure for interest rates to rise. But it is just a matter of time before we begin to see acceptance that interest rates will have to come down again into deeper negative rates instead as the economy slows again. Grains are beginning to explode as a consequence of shortages in food. Soybeans are breaking out, as is soybean meal. These are moves. These moves indicate that inflation is in the grain markets already. We expect the metal markets to follow suit soon and move up significantly. Therefore, gold and silver are in a major buying opportunities. Be patient, MontesDeOca said. Continue to add to your positions in gold and silver at these levels. They are completely oversold in relation to the prices of other markets and commodities. We have been waiting since August 2020, a longer than expected correction. But do not despair. The time is coming and gold and silver will move up when you least expect it. Continue to accumulate and buy gold and silver. Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2Trade.com, or listen to any of our previous episodes.